Yeah, so that's it. I want 100 shares of Stretch Rubber Band Company at $20 a share or better.
Okay, I'll get back to you to confirm.
Thank you. Good. What I have just done is I have put a stock deal in motion. This is done every business day, just like that, by millions of investors all over the country. But after you hang up the phone, then what happens? I told my broker just now to buy 100 shares of Stretch Rubber Band. After I get off the phone, he telephones one of the nation's several stock exchanges. Let's say in this case it's the New York Stock Exchange. My order is relayed to a specialist on the exchange floor. He handles all the buy and sell orders for Stretch Rubber Band. He matches them up, he sets the price, and if there is another investor out there who is willing to sell me Stretch Rubber Band at $20 a share, I have got a deal. The specialist then relays the message back to the broker. And...
Bob, this is Chet. You've bought 100 shares of Stretch Rubber Band Company at $20 a share.
Listen, hold on a sec. They will always repeat the exact terms of the deal. Exactly. After all, I am making a $2,000 purchase, and I do want to make sure that I've got the terms precisely right. Chet, that's... Chet? Busy man. All right. The deal is now set. But what exactly did I buy? Well, I'm going to show you a stock certificate. This is what they look like. And it says here that I bought 100 shares. That's my name on top, 100 underneath. This represents a portion of ownership in the Stretch Rubber Band Company. I am now a partner in this company, along with millions of other shareholders of Stretch. So my 100 shares represents just a tiny portion of ownership, but I am an owner nevertheless. I have a right to vote on important issues facing the company, including management. If it's a good year for Stretch Rubber Bands and the company makes money, I have a right to receive a dividend payment. But what's most important, and the real reason that I bought this stock, is that if the value of these 100 shares goes up, and I'm kind of hoping that they will, I can sell them for a profit. That is why I invested in the stock market. The market is a great way for me to build up my nest egg, to build my capital, but it does the same thing for companies, and that is why they issue their stock in the first place. I want you to look at our fictional company. This is the Stretch Rubber Band firm. It is a business made up entirely for this course, but it'll give you a real idea of how these things work. Now, here's the story of how Stretch got started. Back in the year 1870, a young Dutch immigrant named Johannes Strijge started the firm. He was a young scientist, and he had been experimenting with rubber. During the Civil War, he had tried to make and sell rubber bottles. But one day while eating lunch in a local bakery, he accidentally dropped his bottle into a bread slicer, slicing it into a dozen circular strips, much like this example here. This gave him an idea. Like many real entrepreneurs, Strijge took this thing to some financiers, in this case in New York. They liked it, and the firm was launched. That's how a lot of companies start. But after a while, Strijge wanted to expand the plant and hire more people. Now, to do that, it turns out, would have cost about $1 million. He didn't have the money himself. But he could go either to a bank to borrow the money, or he could go to you in the public, and invite you to become partners in his business by selling shares for cash. And in 1898, that is exactly what Johannes did. By that time, I should mention, the family had changed its name to Stretch, because that sounded a little more American to them. The Stretch Rubber Band Company sold 1 million shares at $1 a share and raised $1 million, built the buildings. Every share that is now trading on the country's various exchanges was originally sold to the public by an individual company. That's why companies get into stocks. They want your money. But what about you? Well, you can make those stocks work for you, building your capital. You may not make a fortune. The market does not make everybody rich. But if you work at this, you can learn to invest for profit. But first, you've got to know where to buy and where to sell. Basically, there are two markets where stocks and bonds are traded, the securities exchanges and the over-the-counter or OTC market. Let's take a look at the security exchanges first. The largest and the most important is the New York Stock Exchange, the big board. The big board accounts for more than half the annual value of all stock trading in the country. Generally, the country's biggest companies are listed on the big board, but number two is the American Stock Exchange. And then there are regional stock exchanges, including the Midwest Stock Exchange in Chicago, the Pacific Stock Exchange in San Francisco, and the Philadelphia Exchange. All these exchanges are similar because at each one, all of the trading goes on in one central location. The over-the-counter market, though, is different because there's no one place where the buying and the selling takes place. The stocks are not literally sold over the counter like at a drugstore. Instead, there are hundreds of separate dealers and brokers making lots and lots of deals all over the country. These transactions are increasingly centralized by a computerized system called the National Association of Securities Dealers Automated Quotation System, or much more simply, NASDAQ. On the over-the-counter market, you'll find a lot more companies than you will on any of the securities exchanges. Generally, they are smaller and they're newer companies. No matter where you want to trade, either over-the-counter or at the big exchanges, you're going to do it through your broker. Your broker is going to play a vital role in your investment life, so you should think carefully before you choose one. So you're probably asking yourself, how do I find a good one? Well, probably the best way is to ask a friend, the same way you would if you were looking for a good doctor or a good lawyer. But keep in mind that there are two kinds of brokers, and we've brought a pair of brokers here into the studio with me. One of them is a full-service broker. The other is a discount broker. See if you can figure which is which. I've decided to make her my full-service broker. Now, let me tell you about her. First of all, she's going to charge me more money. On the other hand, she's going to do more for me. A full-service broker normally has a research department. The researchers in that department keep tabs on companies all over the United States. She gets to know a lot of firms. She gets to know them well, and then she can make recommendations to me on what I should buy or what I should sell. She also bothers me a lot. She calls me all the time. Now, don't forget, a full-service broker makes a living on commissions. She wants me to buy and sell all the time because every time I do, she makes money, whether I make money or not. So even if you use a full-service broker, don't depend entirely on her advice. But this guy, the discount broker, a whole nother thing. He is considerably cheaper than she was. He works for commissions, but they're much less than the full-service commissions, sometimes half the price. On the other hand, all he does is place orders for me. He won't give me any advice. He won't even look at me. But I have to know what I want to buy and what I want to sell, and if I do, he'll do it for me. All right, let's say you found your broker, either one. Now you got to know how to talk to her or to him. So let's go back to that stock deal I made a few minutes ago, and this is how it all started out.
Trading.
Hi, can you give me a quote on RUB?
Just a minute.
RUB is the symbol of the stretch rubber band company on the New York Stock Exchange. So what the broker's doing right now is he's punching that symbol into a computer, and then the computer is going to display the current price. Yep.
RUB is 20 and a quarter, up a quarter.
Now that means that the current price for the stock that I want is 20 and a quarter, or $20.25, up 25 cents, literally a quarter since yesterday. Now, I got to decide what to do. If I think that 20 and a quarter is too high a price to pay, I can do nothing. But if I really want this stock, and if I think that the price is moving up fast, here's what I do. Hi, I want 100 shares of RUB at the market. Now, excuse me, that phrase, at the market, means that when my order reaches the exchange floor, I will pay whatever the market price is then. If at that time it's gone up to 22.5, I'm going to have to pay 22.5. But there is a second way to order stock. Suppose I'm on a budget and I can only spend $20 a share for the stock. Or suppose I think that the price sometime later today